Hello and welcome. In this lecture video, I'm starting on page 170 of your course pack, and I will talk about journal entries for credit card sales, and then I'll also talk about installment sales, and then we'll do some quick check problems, okay? So as we were saying earlier, a lot of companies, restaurants, any kind of merchandiser, Staples, Best Buy, Amazon, you go down the line, they let you use credit cards. And we talked in the last lecture video about why companies let you use credit cards. One of some of the main reasons is they just can outsource the credit decision to the credit card, and they typically get their cash sooner, and they also don't have to worry about following up with you to make sure you pay them. The credit card company pays the company, and then you pay the credit card company. So if you don't pay, the credit card company is going to be the one to come knocking on your door, not the restaurant downtown. Okay? So let's talk about journal entries. Okay, so I'm going to go ahead and flash forward here to page 171. There's two different situations with credit cards. There's a situation where the company could, the restaurant, for example, if you go to a restaurant and you put your dinner on the credit card, the restaurant could get their cash pretty much right away. Okay? And then there's the restaurant where there's a situation where the restaurant may have to collect all of their receipts and send them to the credit card company and then wait for the credit card company to reimburse them. So this just affects what journal entry we do at the time of sale. Because if the restaurant gets cash right away, then they can debit cash. But if they have to wait to get cash because they have to remit the credit card sales receipts to the credit card company, then wait for the credit card company to pay them, then they have an accounts receivable because they didn't get paid right away. All right? So let's look at the first situation, which is they get cash right away. So we say here on July 15th, TechCom has $100 of credit card sales. And then as I was saying earlier, when a restaurant or any other company lets you use a credit card, they get charged a fee for that. So in this case, the example here is 4% fee. So how much cash do they get? They get $96 in cash. Okay, so let's look at the journal entry. So on 7/15, they're getting cash right away, immediately. So we're going to debit cash, and our sales were $100. But we have a 4% fee. So we are debiting cash for $96. Okay? Then we can credit sales for our $100. Okay? And what you know is that debits have to equal credits, so you know we're missing a debit here. And what does the debit go to? It goes to credit card expense. Okay? Debit to cash, $96, debit credit card expense, $4, and then credit to sales for $100, okay? You have to do this. You have to pay the credit card company for using the credit card, all right? And this is another expense on the income statement. So remember, as our expenses go up, our net income will decrease. So this will decrease our net income. Okay? Let's look at the situation where cash is received sometime after deposit. So that's what I was saying a few minutes ago, that the situation is that our company has to remit electronically the credit card receipts to the credit card company and then wait for cash. In that case, when they record the sale on 7/15, so let's say they record the sale on 7/15 and then they get paid a few days later on the 20th. So now we have two journal entries. The first one is to record the sale on the 15th, and then the second journal entry is to record when we get paid on the 20th. So here it's similar to the one that we did where we got cash right away, except we don't debit cash, we debit accounts receivable. So I'll debit accounts receivable for my $96. I will debit credit card expense for $4, and then I will credit sales for my $100. That's on the 15th. Now, what about on the 20th when we get paid? Well, when we get paid, right, we know what to debit. We always debit cash. We debit cash for our $96, and then we credit, and again, my abbreviation for accounts receivable is AR, so we credit accounts receivable 96. So again, to quickly recap here with credit card sales, we have two situations. We could get cash right away, or the company may need to remit electronically their credit card receipts to the credit card company and then wait for reimbursement for the credit card company. If they have to wait for reimbursement, they can't debit cash when they make the sale. They have to debit cash when they receive the cash a few days later. Okay? So those two situations. And then again, as economists like to say, there's no free lunch. If you let customers use credit cards, you have to pay for that, right? In this case, there's a 4% fee. And companies are going to be charged for letting you use their credit cards. And again, why do they do that? Well, they outsource that credit worthiness check to the credit card company, and they outsource the collection to the credit card company, but they have to pay for that. And that's this. That's that expense that they have to pay. And again, that's why Carl's, I'm guessing, I haven't talked to Carl. My guess is the reason that he doesn't want credit cards is because he doesn't want to pay this. He does not want to pay this, and he doesn't have to. Because if he says we won't accept credit cards, so what? Still go to Carl's because the ice cream's awesome. All right? So, I've done those two journal entries. This one we did on the prior page. This says right over here when cash is later received. That's that 20th. Okay? So now let's talk about installment sales, and then we'll do some quick check problems, okay? So installment sales are amount owned by customers for credit sales for which the customer will make periodic payments. So if you've ever bought a car before, right? Your car payment is the same dollar amount every single month. I bought a car and I had to pay $200 a month for 5 years. I think it was something like that. And so when I do that, right, part of my payment goes to interest, part of my payment goes to principal. So that's called an installment sale. So it's our periodic payments over an extended period of time. And then when that happens, when that customer is making their payments, part of their payment, which always stays the same, it's always $200 a month or $300 a month or $600 a month, whatever it is. Right? Part of their payment goes to principal, part of their payment goes to interest. And in Accounting 102, we will talk about how to calculate the payment and then also how to determine how much of the payment goes to principal and how much of the payment goes to interest. We'll talk about that in Accounting 102, so you'll have to hold your breath and wait. Okay? But for now, what I want you to know that installment sales, right, even though they can be over multiple years, right? A lot of car companies now are extending car payments over 6 years. This is a very long time. Even though those installment sales occur over multiple years, which means they cross over the operating cycle, right? The accounting period, 1 year accounting period. Even though they do that, we can still classify them as current assets as long as customers are making those regular payments, which is what we'd assume, because those are the credit terms. And that's what I'm saying over here. Although the installment accounts receivable can have periods of more than 1 year, let me focus there, they are classified as current asset if the seller regularly offers customers such terms, which is very common with purchasing a car. Okay, that's an installment sale. A mortgage. If you've ever bought a house before, if you know someone who's bought a house before, I bought a house, I own a house, and I make a mortgage payment every month, and it's always the same every month. And part of my payment each month goes to principal, and part of my payment goes to interest every single month. And so that would be another form of an installment sale. Okay? So let's go ahead and look at page 175 right over here, where we have these quick check problems on page 175 and 176. What I want you to do is to pause the lecture video and sorry about that. I want you to pause the lecture video and then do these problems and then come back and check them, okay? So do these problems on pages 175 and 176, and then we'll come back and check them. Thanks. Okay, so let's see how you did. Number 58, sellers allow customers to use credit cards. To E is the right answer. All of those to evaluate, to avoid having to evaluate a customer's credit rating for each sale. That's true. To lessen the risk of extending credit to customers. That's true. To speed up the receipt of cash from a credit sale. Yep. And to increase total sales volume. E is the right answer. All of those. Number 104, our company accepts all major credit cards, including Omnibanks, which assess a 4% charge on sales for using a credit card. June 28th, Hanco had a $3,500 in Omni credit card sales. What entry should Hanco make on June 28th to record the deposit? And we are assuming that cash is received immediately. So that means anywhere where it says debit accounts receivable is wrong, because it says cash is received immediately. So it's debit cash for our 96% of the sales amount. So what I did over here, you can see I took my $3,500 sales times 0.04. That gives me my debit to credit card expense of $140. The cash received is equal to the amount of sales minus credit card expense of 4%, $140, gives us $3,360. So D is the right answer. Debit cash, $3,360. Debit credit card expense, $140. And credit sales, $3,500. Looking at this last one on page 175, number 1, accounts receivable can occur from credit to sales to customers. Yes, that is true. Okay. And then we look at the top of page 176. Credit sales are recorded by crediting an accounts receivable. No. When do we credit an accounts receivable? When we get paid. Not when we make the sale. We make the sale as a debit to accounts receivable. Okay? Number 57, a credit sale of $3,275 to a customer would result in A is the right answer. The debit to accounts receivable in the general ledger, and then also a debit to the customer's account in the subsidiary ledger. Because if you don't debit each, it won't stay in balance. If you go through and you try to add up all the individual receivables from each customer, it won't equal the total if you don't update it in the general ledger and in each customer's individual accounts receivable. Okay, so that's why A is the right answer. So remember, a debit increases accounts receivable. So I'm increasing the accounts receivable in the general ledger because it's debited. And then I'm also increasing the customer's account in the receivable subsidiary ledger with a debit, because debits increase accounts receivable. So the general ledger is increasing, and then the subsidiary ledger is also increasing by $3,275, which means it will stay in balance. If you don't do both, right, they won't stay in balance. Okay? And then we wouldn't credit accounts receivable. That's when we get paid. Okay, so anywhere where it says a credit accounts receivable, that's when we get paid. So that's why that doesn't make any sense. Okay, it has to be a debit to the general ledger and then a debit to the customer's account, because debits increase the accounts receivable. And that's what's going on. All right, because we made a credit sale. So remember, the journal entry here would be debit to accounts receivable, $3,275. Credit sales, $3,275. And then this is posted to the general ledger, GL, and also to the customer subsidiary ledger. Okay, sorry about that. So this is our journal entry, debit accounts receivable, credit sales. That would be posted to the GL and to the customer's subsidiary journal ledger. And so maybe writing out that journal entry to see that it's a debit would help you to understand why the answer is A here. Okay. All right, so I'm going to end this lecture video now, and then the next one we'll talk about the direct write-off method. Thanks so much.